Hello, hi, I'm Arvind Chari. I'm the Chief Investment Officer at Quantum Advisors. Since we last spoke last month, quite a bit has happened in the economy, in the markets, and I'm here to take you through what happened and what's our outlook towards different asset classes, equity, fixed income, and gold. So the main start of the month was the budget, and we really liked the budget in the from the sense that the government has continued to focus on growth and has ensured that they will spend more. So they'll keep the fiscal deficit slightly wider than what they intended. And that spending will be focused more on capital expenditure. As we've said before, India is a growth market. Growth is India's priority, should always be India's priority. And once we get the GDP growth to a normalized level, that tends to solve a lot of our macro problems. So that's this focus from the government 2 years in running, and also expected to continue over the medium term, is good to know that that there is a clear goal to get growth above and get growth going. And as the government spends more on capital expenditure, and if they do it in an efficient manner, in a timely manner across center and states, I think that will also crowd in and try and get private investments and the private corporate capex cycle, which we have been waiting for. I think that will also happen over a period of time. So that aspect was very good. The disappointing aspect, which is what when we wrote our note, we said growth priority but balance missing, is the fact that out of the total 40 lakh crore of the government expenditure, we still believe that some amount of that spending, instead of completely going on capital expenditure, could have also gone to support income. It could have been a direct income support to some of the marginalized or most impacted segments of the economy over the last 2 years. It could have been a tax cut on certain commodities, which then makes prices cheaper for people to buy. Or it could have been kind of some tax holiday for MSMEs, so that they, having been battered by a regular crisis, come about and have some leeway to support. I think that was missing, that direct income support or consumption support or support directly to segments of the economy which has got impacted. We felt that is still missing from this government's agenda. So overall, great. There were no negatives, major negatives. That is always a very good thing when a budget document does that. Priority is to get growth back, but we would have liked to see some amount of demand stimulus, some amount of consumption spending. But nevertheless, I think the markets really took it well, and it bodes well for our overall view that India is on the cusp of a sustained economic revival, and this spending by the government and the focus on capital spending will continue that momentum, and we will see GDP growth remaining reasonably above what our previous expectations was. A week later, we had the monetary policy from the RBI. We found that what we called needlessly dovish, where the market was expecting the RBI to announce some kind of what we call monetary policy normalization, which is either increasing the reverse repo rate or increasing interest rates, and some amount of guidance on when they will remove liquidity and when they will move the stance from what they are accommodative to neutral, because we believe that we are no longer in crisis. I think the crisis part of India is well behind us. We are stabilizing in the economic level, and hence monetary policy also need not be at crisis levels. And we were looking for an indication from the RBI that when and how will they normalize the monetary policy. But they were very, very dovish in the sense that they didn't even talk about liquid normalization, no talk of change in stance, no hike in the reverse repo rate. So they are very much status quo, very much focused on reviving growth. We found that at odds, given where commodity prices are, given where oil prices are, and given where the global central bankers are in terms of, if you look at the developed world central bankers with ECB and the Fed, especially the Fed, the US Fed, they are in the tightening cycle. They are going to increase interest rates. And in that scenario, India is among the few emerging markets which has not even indicated a increase in interest rates or change in monetary policy. And not that we do not have inflation pressures. So of course, inflation is estimated to be lower as compared to last year. But still, we would have seen some aspect of guidance towards how they will increase and normalize monetary policy. The bond markets loved it. There was a very quick rally after the monetary policy, but as oil prices have gone up and as geopolitical concerns have come about, we've seen the bond yields, although they're still lower than what they were post-budget, but it's still fairly range bound. So we had talked about two risks last time, in the sense that these are the only two risks that we see for the equity markets, for example. One was that India was relatively overvalued as against other emerging markets and other countries. And we sense that foreigners would be looking to book profits because of the huge rally that India has had in 2020 and 21, and take that money and allocate to other beaten down emerging markets. And that seems to be happening. We've seen significant amount of selling by the foreigners. YTD, like just in 2022 till date, almost $8 billion of selling from foreigners in the equity markets. That is quite significant. And this selling has, if you look at the pattern, it's been continuing since October of last year. So that move away from India, because India is expensive from a relative valuation perspective, and that India has had great gains. I think that foreigners are really taking that call. The other short-term risk that we had mentioned was the entire geopolitical aspect, especially with respect to oil prices. And from what we've heard overnight, with respect to Russia and Ukraine, oil prices are now heading towards $100 Brent oil prices, and that is a very, very significant short-term macro risk for India. And we are seeing the impact of that across equity, currency, and the bond markets. And so this kind of that correction that we were kind of not expecting, but postulated that if these two aspects play out, you will see a market correction. I think that is playing out. We think this is healthy for a medium to long-term investor perspective. We don't see any major downgrades to our earnings estimates of companies that we made. What we're seeing with the sell-off is some kind of P, what we call re-rating, and contraction of P, because some segments of the market were really overvalued. We still remain hopeful of the overall economic recovery, and based on how we are positioned in our portfolio, and based on other valuation parameters and earning estimates, we would believe that another 10% or so, kind of fall in the markets would kind of make us change our client recommendation from what we had said, that neutral allocation to India. We would actually be asking for our clients to increase their allocation to India, from a foreign investor perspective, and also from a domestic, investor. We think these corrections are a good opportunity to be able to build your long-term equity wealth creation portfolio. So, things will be volatile. We've said that before. Things will be two-way movements. You will see a lot this year. There'll be a lot of divergence in expectations and reality. But if you're a medium to long-term investor, you should embrace these kind of corrections. The other asset class that we normally generally recommend as a passive allocation, which is gold. But we believe that there are a lot of things going for gold in the current scenario. One is clearly this geopolitical uncertainty. We've always seen that in times like these, gold tends to do very, very well. As also, if I look at from a relative perspective, which is gold was being compared to, say, crypto assets and cryptocurrencies. But given the volatility that those asset classes have seen, and the fact that as risks have gone up, you're seeing crypto assets and cryptocurrency actually falling. So that store of value perspective that people thought crypto assets will have, it's actually not playing out. And gold is kind of playing that store of value, portfolio risk diversifier, will do well during uncertainty. That role I think gold is playing. I think as more and more people realize that, you will see allocations increasing towards gold also, especially in the current uncertain environment. So that we believe that there are some tailwinds for gold. Although our general advice and allocation towards gold is that it's a passive allocation. Have between 10, 15, 20% of your overall wealth portfolio in gold as a diversifier. But there are some tailwinds for gold that we see. Also, if the high oil prices, global uncertainty, outflows from equity markets, hawkish Fed, all those put together have some pressure on the INR also. So we will expect the rupee to depreciate, although the RBI can manage the depreciation. But any rupee depreciation is also positive for gold prices in INR. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.